Most people believe the market is the reason they are not rich. They believe wealth is decided by timing, by finding the right stock, by entering before everyone else notices. So they keep searching. They read more news. They watch more charts. They wait for the perfect moment. They tell themselves that once they learn enough, once they find the right strategy, everything will finally change. But years pass, markets rise, markets fall, booms turn into crashes, crashes turn into recoveries. And somehow they are still standing in the same place. The uncomfortable truth is simple. Investing alone does not make people rich. Many people invest for decades and never build real wealth. Not because they chose the wrong assets, not because the market was unfair, but because they never changed the person making the decisions. The market does not reward effort. It does not reward activity. It does not reward intelligence in the way most people expect. The market rewards behavior. It rewards patience when nothing is happening. It rewards discipline when fear is everywhere. It rewards restraint when temptation feels justified. Most people fail at all three. They react instead of think. They chase instead of wait. They confuse movement with progress. When prices rise, they feel smart. They feel confident. They feel validated. When prices fall, they feel anxious. They feel betrayed. They feel an urgent need to do something. In both moments, emotion quietly replaces judgment. The market does not care. It does not know who you are. It does not know how hard you work. It does not know what you need this money for. It simply reflects behavior back to the person standing in front of it. That is why two people can buy the same asset on the same day at the same price and end up with completely different outcomes. One remains calm, one panics. One holds through boredom, doubt, and long periods of silence. One exits at the first sign of discomfort. Same investment, different reactions. And reaction is destiny. Most people want wealth without changing how they think. They want returns without restraint, growth without patience, success without emotional control. They want the reward, but not the discipline that earns it. The market has never worked that way. Before wealth becomes a financial outcome, it is a psychological one. Until that is understood, no strategy will save you. No stock will rescue you. No perfect timing will protect you. This is why most people will never be rich, even if they invest. Because the real problem was never the market. It was always the person. Many people believe they are doing the right thing because they are investing. They own stocks. They hold ETFs. They contribute regularly. On the surface, everything looks responsible. But investing activity is not the same as building wealth. Movement is not progress. Buying assets does not automatically create discipline. It does not create patience. It does not create emotional control. Most people confuse participation with mastery. They enter the market without understanding risk. They invest without accepting volatility. They expect returns without discomfort. When prices rise, investing feels easy. It feels logical. It feels rewarding. But when prices fall, the truth appears. Doubt replaces confidence. Fear replaces plans. Short-term pain suddenly feels unbearable. And that is when investing turns into speculation, not because the asset changed, but because the mindset did. Many investors do not actually believe in what they own. They bought because someone recommended it, because it was popular, because it recently performed well. They hold nothing with conviction, only with hope. Hope is not a strategy. When conviction is missing, patience collapses. When patience collapses, decisions become reactive, and reactive decisions destroy long-term results. This is why so many people buy high and sell low, not because they are unintelligent, but because they never defined why they were investing in the first place. Real investing requires clarity. Clarity about time horizon, clarity about risk, clarity about what kind of volatility can be tolerated without panic. Without that clarity, every market movement feels personal. Every decline feels like a mistake. Every headline feels urgent. Wealth is not built by constantly adjusting. It is built by holding through periods that feel unproductive, boring, and uncomfortable. Most people cannot endure that. They want confirmation. They want excitement. They want quick feedback. But the market rewards the opposite. It rewards those who can do less, those who can wait longer, those who understand that real wealth is slow. Investing is a tool. Wealth is the result of how that tool is used. And without the right mindset, investing becomes nothing more than motion without direction. Most people believe investing is about intelligence, about analysis, about information. In reality, investing is mostly about emotional control. Human nature did not evolve for long-term thinking. It evolved for survival, for quick reactions, for avoiding pain. And the market exploits this perfectly. Fear pushes people to sell when prices fall. Greed pushes people to buy when prices rise. Envy pushes people to chase what others are bragging about. None of these emotions care about long-term outcomes. They care about relief. They care about excitement. They care about feeling safe in the moment. The market constantly triggers these instincts. Sharp declines feel like danger. Rapid gains feel like opportunity. Human nature responds instantly. Logic arrives late. This is why plans disappear under pressure. This is why discipline collapses during volatility. This is why people abandon long-term strategies for short-term comfort. Most investors do not fail because they lack knowledge. They fail because knowledge cannot compete with emotion in real time. When fear appears, the brain demands action. Doing nothing feels irresponsible. Waiting feels risky. Silence feels wrong. So people act. They sell to stop the pain. They buy to avoid missing out. They change strategies to regain a sense of control. Each decision feels justified in the moment. Each decision feels reasonable. But over time, these small emotional reactions compound into permanent damage. Human nature hates boredom. It hates uncertainty. It hates being wrong. Yet successful investing requires all three. It requires long periods when nothing happens. It requires accepting uncertainty without constant reassurance. It requires being wrong temporarily without panicking. Most people are psychologically unprepared for this. They want certainty in an uncertain system. They want smooth progress in a volatile environment. They want emotional comfort in a process that offers none. The market does not punish ignorance. It punishes emotional weakness. Until human nature is understood and restrained, every strategy will eventually fail. Because the real enemy was never the market. It was always the instincts brought into it. Compounding is often described as the most powerful force in investing, but very few people ever experience it, not because compounding does not work, but because it works too slowly for human patience. Compounding requires time, long stretches of time where progress feels invisible, where results appear flat, where effort seems unrewarded. This is where most people quit. They enter investing with enthusiasm. They expect momentum. They expect confirmation. They expect visible improvement. But compounding does not announce itself early. In the beginning, progress feels disappointing. Small gains look insignificant. Short-term setbacks feel discouraging. So doubt creeps in. People begin to question their strategy. They compare their results to others. They wonder if they chose the wrong assets. They wonder if they started at the wrong time. And slowly, patience erodes. They adjust. They switch. They restart. Each change feels logical. Each change feels like improvement. But every reset quietly destroys the one thing compounding needs most: time. Compounding only works when decisions are allowed to age, when capital is left undisturbed, when periods of boredom are tolerated without interference. Most people never allow this to happen. They interrupt the process too early. They exit just before momentum begins to build. They abandon strategies during the exact phase that feels the most uncomfortable. This is not a failure of intelligence. It is a failure of endurance. Compounding rewards those who can sit through doubt, through boredom, through long stretches of uncertainty. It punishes those who constantly seek reassurance. The market does not require brilliance. It requires staying power. Those who remain long enough eventually benefit from acceleration. Those who leave early experience only frustration. And this is why compounding feels mythical to most people. They hear about it, they believe in it, but they never stay long enough to witness it, not because they lacked opportunity, but because they lacked patience. Most people believe wealth is destroyed by bad investments, by market crashes, by choosing the wrong stocks. In reality, wealth is often destroyed quietly, not in the market, but at home. As income rises, lifestyle follows. A better car, a bigger home, more convenience, more subscriptions, more obligations. Each upgrade feels deserved. Each upgrade feels reasonable. But together, they create a system that consumes every future gain. Investing accounts may grow. Portfolios may look impressive on paper. But cash flow remains tight. Stress remains constant. Not because investments failed, but because lifestyle expanded faster than discipline. Most people do not lose wealth in a single mistake. They lose it gradually, through habits that feel normal, through spending that feels justified. Lifestyle inflation is rarely dramatic. It is subtle. It happens slowly. And that is why it is so dangerous. The more fixed expenses increase, the less freedom remains. When markets decline, fear intensifies, not because losses are unbearable, but because obligations are inflexible. Debt demands certainty. Bills demand consistency. Lifestyle demands constant income. This pressure forces short-term decisions. It turns long-term investing into a fragile balancing act. People are no longer investing for growth. They are investing for survival. And survival thinking does not tolerate volatility. True wealth requires margin. Margin of money, margin of time, margin of emotional space. An overloaded lifestyle removes all three. This is why many investors sabotage themselves even during favorable markets. They never allow wealth to compound freely because every gain is already assigned to a higher standard of living. The market did not destroy their wealth. Their lifestyle did. Charlie Munger was never trying to teach people how to get rich quickly. He was trying to teach people how to avoid destroying themselves. His message was often misunderstood. Many heard it as conservative, as boring. as outdated. But that misunderstanding is exactly why it matters. Munger understood something simple and uncomfortable. Most financial failures are self-inflicted. People do not lose because they lack opportunity. They lose because they compound mistakes. They overtrade. They overreact. They overleverage. They overestimate their own ability. Munger did not admire brilliance. He admired reliability. He believed success comes less from being smart and more from avoiding stupidity, avoiding obvious mistakes, avoiding emotional decisions, avoiding situations that force bad behavior. This is why he spoke so often about temperament, about patience, about knowing one's limits. He understood that markets will always be unpredictable, but behavior does not have to be. The goal was never to be the fastest, or the boldest, or the most confident voice in the room. The goal was to stay in the game, to survive mistakes without being wiped out, to endure boredom without seeking excitement, to accept slow progress without forcing acceleration. Munger believed that time does most of the heavy lifting, but only for those who remain standing long enough. That is why leverage scared him. That is why complexity repelled him. That is why overconfidence worried him. Not because these things never work, but because eventually they break people. His philosophy was not about maximizing returns. It was about minimizing regret. Not about winning big, but about not losing permanently. Most people ignore this advice because it sounds too simple, too slow, too unexciting. Yet the people who follow it are often the only ones still standing decades later. That was the real warning. Not how to get rich faster, but how to avoid self-destruction long enough for wealth to arrive on its own. Most people believe wealth comes from a single decision, a lucky investment, a perfect entry, a bold move at the right time. That belief is comforting because it suggests wealth is an event. But wealth is not an event. It is a long pattern of behavior. People do not fail because they never invested. They fail because they could not hold. They could not wait. They could not stay consistent when nothing was happening. They looked for shortcuts. They searched for confirmation. They abandoned discipline the moment discomfort appeared. Over time, these small choices shape the outcome. Wealth does not respond to intelligence alone. It responds to temperament, to patience, to restraint, to the ability to do nothing when doing nothing feels wrong. That is why two people with the same income, the same opportunities, and the same access to information can end up in completely different places. One builds margin, the other builds pressure. One stays calm during uncertainty, the other demands constant reassurance. One allows time to work, the other interrupts it. Markets will always fluctuate. Opportunities will always come and go. But character remains, and character compounds. This is why most people will never be rich, even if they invest. Not because the market is cruel, not because success is reserved for a few, but because wealth requires becoming someone different, someone who can tolerate boredom, someone who can endure doubt, someone who can resist the urge to act for emotional relief. Wealth is not built in moments of excitement. It is built in long stretches of quiet discipline. And those who understand this do not need to rush, because they know the process is already working.